The context is to basically be able to help everybody raise money. We all know that capital is our most important resource, and therefore we want to do it right. So this is a basic idea for funding readiness. What used to happen was, over my interactions with all of you, some of you asynchronously and one-to-one conversations, I would end up repeating the same thing, and then I realized that, hey, it makes more sense to try and speak to everybody, so everybody has the same context, and maybe a question that one founder asks is useful to another founder as well. So that's why, in the hope of being more efficient and transparent, just put together a very small slide deck. It's super casual. Don't hold me to the slides. It's not my best work, but this is just to sort of aid the discussion and for me to structure my thoughts, then actually more to present to you. So, like I'm saying over here, every rocket ship needs fuel, every startup needs capital. So we're going to try and answer some important questions today: how much to raise, what value to raise, what structure to raise in, who do we reach out to, how do we reach out, and how do we close. So how much to raise, right? So typically, all of you, everybody here is part of Launch Camp 1 or 2, and the round sizing is for companies of our size is typically 9 to 12 months at minimum, and ideally, if we get the positive market, then 12 to 24 months. So what that means is that, considering a 90-day raise cycle, we should always raise for about 12 months, so that you have enough of a runway before you go back into fundraising mode. Otherwise, we're always in fundraising, and nobody likes to be in that mode as a founder. We want to be able to execute, run our businesses. So fundraising is not our core strength. And whatever you do, please plan a 10 to 20% contingency, either in the budgeted expenses or in the raised amount. So what I mean to say is, suppose you put together a budget and you need $500,000. Now for $500,000, take a target to raise $600,000, because that's 20% more. Also, what's not written here, but what's important, is that when you're choosing your amount and you arrive at this number, please set a minimum number. So suppose, let's continue with the same example, that the startup is raising $500,000. So they still need to have a minimum which says, I have to have $250,000 or $300,000 to run this year, and therefore I will not accept less than that money. That is important, because if you suppose agree to a lower amount of money because it was available and it was getting tough to raise more money, it is only pushing the problem out. So you may not be able to raise 500 or even 300. If you get 100, don't take the 100, because you are answerable to the 100k investors, but you will lose out on being able to build anything meaningful, and they will feel that our promise was under delivered. So what value to raise, right? So now I know I need $500,000. Pranav startup needs $500,000 and minimum is 300,000. And what value do I raise? So I've just given you some range, because it's important that you keep these range in mind. There is nothing set in stone, right? Somebody could be pre-product and still raise at $50 million valuation. But my point is, typically for startups like ours, which are in launch camp, which are having founders that are either in their first startup or their second startup, with the first one not being super successful, then in that case, this is the typical range for each of the stages that the company is raising in. So if you're raising at pre-MVP, pre-product, you're looking at a $1 to $2 million post money. If you're looking at a post MVP but pre-revenue, you're looking at $2 to $5 million. And on the upper side, maybe even $10 million if there is a good amount of technology or IP or sort of value in the product. Since this is a post MVP, you are able to take this and give it a demo or something and already have some LOIs lined up, etc. Then you can even aim for $10 million. Post product and revenue, but pre growth. So you have your early customers, or you have a couple of customers even. then you're looking at $5 to $10 million easily, and this can go as high as $25 million if there is a huge and good sales pipeline with great traction. Post revenue, ARR multiples, benchmarks in Web3 aren't yet firmed up as I've written over here, but I would say the sky is the limit. And if you're able to create revenues that are really good, because one thing you would notice about Web3 companies is a lot of Web3 companies have not been able to generate revenues from their business models. Most of them are still surviving on venture capital, and therefore if somebody has revenue which is on an ARR recurring basis, then that is a huge value to the VC. And my personal suggestion and experience is, at this point, please value the money more than the valuation. So what I mean here is, continuing with my example of $500,000, if I am able to piece together the $500,000 investors and they want to fund me at 2.5 million post money, which is 20% of my company, but I wanted to do it at 5 million, then my logic would be, please accept 2.5 million, because with the 500K, you will be able to build your company and grow your company, which will compensate for this potentially in the next round. So by not taking this money now and fighting for the valuation, you may end up causing delay and even losing out on investors. And in a bad market, it's always better to take the money rather than fight for the valuation, because that 2-3% that you may lose now may not be lost forever, right? You can always do it better, because if the market is as strong as it is today or even better, then in the next round, 1 year later, 1.5 year later, you will be able to raise at a much better compensation, at a much better value, to compensate for this hit over here. Lastly, use structures. We'll talk about this in the next slides, but you can use some structures to create a win-win situation between you and the investors. What I always believe is that the investors and the company are on the same side, right? We are together in this journey. So we should not see our investors as somebody who I'm conflicted with. Our investors are somebody who is aligned to us, and therefore we have to come up with a win-win solution at all times. What structure to raise in, right? So SAFE, which is a simple agreement for future equity, this is a most common structure for early stage. Some countries may not allow it, but if they do, the advantage with SAFE is your valuation is not set now. You can set a valuation based on your next round, and even have a cap or a discount structure to the next round to incentivize the current investor. So for example, if I'm raising at SAFE now, the same $500,000, I can tell the investors that you will get a 15% discount from my next round. Most importantly, SAFE is a great tool when we look at fundraising in a winter bear market like right now for Web3. So what we are in now is a Web3 bear market. Therefore, it is super helpful to raise on SAFE with the logic that this SAFE round is a small 6-9 month, 12-month runway, which we will quickly burn out of. But the hope is that the market will turn in that time, and therefore it will be much easier to raise at the next round in a much better market at a much better valuation. Then CCPS is compulsory convertible preference shares or debt, and this is also common. A lot of companies in India do this because India does not allow SAFE agreements. We don't legally allow them, therefore we do it. But these typically have a fixed valuation when you look at them as a structure in the global options. Thirdly, we are all Web3 companies, so please don't ignore the potential of a token round. Today, you may not have tokenomics established, or you may not even have a token thought about, but there is always a potential that you will do a token round in the future. use that to your advantage today and offer the early investors a proportionate token if you do a token round in the future. The advantage here is that the investor does not fear that you will do a token in the future because you are a Web3 company, and therefore they will lose out on that token upside and the equity will not grow. The advantage is you can always structure it to be not 1:1. The example means, for example, if I own 1% of my of this startup's equity, I will get 0.5% of the tokens, or I will get 1% of the token. You can define the ratios, but giving some form of token will make it very, very uh, fair, and it will make the investor very comfortable in the whole structure as uh, both equity and tokens come to them through this one investment. Of course, there is the straight vanilla straight equity, which is as soon as somebody you agree, you have a valuation set out, you receive an investment and you directly issue the shares to the investor. And lastly, do not forget that whatever agreement you do, one solution is to use a roll-up vehicle to consolidate all your angels and family and friends. So we'll talk about this in the next slide, but the idea is that you don't want 100 safe agreements that you have signed, right? Suppose you're raising from 100 people. So you put those 100 people into a roll-up vehicle, like something like Angel List USA or India or Let's Venture India. And that way you have one entry on your cap table and you have one safe agreement with those 100 people. So that is the idea that I generally recommend when you are looking at a early stage startup, and looking at raising capital in the short run and quickly. So now comes, whom do we reach out to, right? Now, I know we all read about VCs from A16Z to Animoca to Sequoia, etc. And of course, we all would love to have our startups invested in by the biggest and best VCs in the sphere. However, most VCs are very unlikely to invest in the first fundraising round of a company unless it's a founder that is known to them. A great example was Newman, who's the founder of WeWork, when he got a single check fundraise from A16Z last year. And that was a great example of how they went ahead and wrote the whole round for him. But it's also a dream scenario for a founder. So if somebody has that pedigree and they have that relationship with existing VCs, absolutely go for it. But otherwise, it's unlikely that we will get VCs in the first round. So therefore, you may choose to not reach out to them at all. And you can ignore that belt, because it is pointless for them to think and have a image about your startup now when it's very early. You would rather go to them a year later with a much more solid business model and a product and a customer base. Secondly, micro VCs and syndicates, they're very similar. Some people call them micro VCs because they've already drawn down the funds. Syndicates are ones which go to their investor base on a transaction to transaction basis. So these are our best bets, and I would say your biggest focus should be to find as many syndicates as you can in your domain, in our case Web3, and find them in your geography and use that syndicate and the group of syndicates you reach out to. The more you reach out to, the better. There is no restriction. Do not agree on exclusivity for any one syndicate unless they're writing at least half the round. So the disadvantage with micro VCs and syndicates is they will typically not take the lead and they will tell you, get me a lead investor. Now the problem is, if VCs don't come in, it's tough to get a lead investor. So the ideal solution is the next part of our slide, which is individuals, and they are called the angels. So every industry has what I would call as marquee angels, or sort of well-known angels who invest in this space. And therefore, if you can crack any of those angels, it just makes it much more easier to manage your perception in the market. The reason is the known angel adds a level of comfort and confidence to the market about your startup. So when a known angel goes in and participates in a round, the startup gets the visibility that, hey, these guys are genuine builders and probably they have the goods because a known, well-known angel investor is taking a punt on them. And though the angel investor may have a smaller ticket size, they can always lead the round as a investment lead. And lastly, do not forget friends and family. Friends and family, to me, I know a lot of us think that, hey, I don't want to go to my friends and family and ask for money. But I always say that it's the other way around, right? If I am starting up and I believe that my startup is worth investing in, then I would definitely take it to my friends and family, because why would I not want them to participate in this and make the wealth that I am also going to make, and have them participate in that journey as well? It helps us on multiple counts. A, it keeps us motivated, it gives us the right reasons to build something meaningful, and it also gives us a very good uh, early capital which we can use to build out maybe a prototype, or maybe even an MVP, or get enough boots on the ground to sort of get an LOI or a sales contract or something which is required in order to do the fundraise from institutions. And one more point over here is, it's super important that you reach out to these guys in the right sequence. We'll talk about it in the future slides. But this is also, so these are the categories of investors. But more importantly, I want that everybody realizes, and we'll look at how to shape it. But the best way to go about a round is to go bottom up from here on this list and start building from the bottom of this list. How do we close? It may seem like the most time consuming and boring activity for a founder. The good way to do it is to basically focus on documentation before you start the process. So you appoint a lawyer, you appoint a tax advisor, and you appoint one person in your business as the spock. If you are a multi-founder company, then one of the founders should be responsible, and it should be made known to them that this is their responsibility. They will make sure that all documentation is ready before we go for the round. The advantage here is that as soon as you have a call and the investor says, hey, this sounds interesting, why don't you send us your term sheet, and you take 5 days to send the term sheet, you've actually lost the investment over there. So the idea should be that we should be able to quickly follow up with our leads, and as soon as we do a pitch, we should be able to send them any documentation or anything that they require, and that was discussed on the call. So the other last point is, don't forget to budget for this in your short term cash flow, because sometimes legal reviews, tax reviews go into high thousands. So you're looking at even 10-20,000 US dollars is not a small number, and I would not be surprised if somebody even said 25 to 50,000 US dollars, especially in countries like America, Canada, etc., Singapore, Hong Kong. So that's another point to make sure that you have the funding and the and the visibility for that documentation budget. How can we help? So now, what is Foundership doing, right? This is the most important thing, and all of the previous things we may have spoken to, or you may have heard from others as well, and it's pretty much available on any podcast or website for a VC or Twitter threads. But what I want to share here is how Foundership is going to help our startups in Launchcamp to raise money. So I'm going to sort of take a pause here, and before I go here, I want to sort of answer any questions about what we just spoke about, and all the slides you've seen so far.
Do your numbers still stand in this current headwinds market? We are realizing that they may not.
No, no, which numbers?
You mentioned about how much to raise in pre-seed, how much to raise post-revenue,
No, no,
pre-revenue.
this is valuation. This
This
is
is
valuation.
valuation. This is not numbers.
Yeah, yeah, that's exactly. But I mean, what we are realizing is that probably given the conditions, this may have to be relooked at also. So should we be relooking at them, or should we stay put with what we have in mind?
No, no, absolutely. So suppose if I were to take the example of pre-product, pre-MVP companies, $1 to $2 million, you can't go lower than this, right? If you, and I'm assuming every company wants at least 250 to 500K, you can't give away half your company for the first round, right? So ultimately, by hook or crook, even by reverse calculation, we will end up at a number between 1 and 2 million to raise even something as small as 250K, because you can't give away more than 10-20% of your company, right?
So even in this market, these ranges seems to be part of acceptable conversations, especially for pre-product and pre-revenue.
Yeah, also if you
Correct.
go dilute too much, it's unlikely that your next investors, will put in that money. So that's also a metric for early stage investors as well as the next stage investors who will be coming in. This should be a dilution rate 10 to 20%.
Yeah, that's ideal, right? And not more than 25. That to 25 should actually be if you are getting a great valuation, right? And you're doing a big round. So that makes sense. That hey, I'm doing $500,000 at 3 million, 5 million. So why not take, then I'll take $1 million and dilute 20% at 5 million.
Yeah, actually, there's a lot of conversation if you see going on around red flags in VCs and partners. And this is one of the red flag. If someone is pushing you for more than 25% dilution, then he's not playing from your side.
Correct. Makes sense, Nikhil. What's been your
Sure.
experience?
Yeah,
Please,
yeah.
I want you to share if you've had specific conversations. We don't need to know the name of the VCs or the investors, but would love to
No,
hear
no.
the content.
Yeah, this is not around the conversations we are having, but the fact that we aren't getting a lot of positive responses right now, and I mean things are slow. Basically, everybody is like in a very slow mode in terms of their decision making. Everybody is waiting for somebody else to lead and all that. So it's the usual challenges. And what I wanted to make sure is that it is not because we may be asking too much. That's what I wanted to validate.
If it were a valuation conversation, the kind of objections or reasons will be very different. It's a question about wanting to make a decision but asking you to reduce your valuation so that they get a higher stake.
No, I think that's a secondary, right? If they really have the conviction on the company and the startup, valuation and the raise and the check size, that's a discussion for later. They'll ask you. That's not a no-go from day zero.
Exactly.
Totally. And personally, I believe that anybody who's investing money would come up with a logic for their valuation. If not, please use the safe route, and you can always put a floor and a cap and say, okay, fine, you want to fund us at 1 million, we want to raise money at 2.5 million. We will do that range, and we will say this is the range subject to a next round valuation of at least $5 million, or $3 million, whatever the number is. So that way, then it's a win-win situation, and we can always look at getting investors in, because like I said, we want you value money over valuation, right? At this stage of the company, if there is no money, there is no company. So 100% of zero is still zero, so it doesn't matter. Hey Pratap.
Yeah, and just answering his other question about the deals slowing. Yeah, deals have slowed. Even the good ones are taking 3 to 6 months of time rather than what used to be earlier 2 to 4 months of time to close deals. So you can expect that it's a market. So fingers crossed, if things go well.
Hey Pranav, I have two questions.
Sure.
You were talking about the attorney fees and the tax consulting, right? Is this something that you incur every time you are, in the middle of a conversation with VC? That's my first question.
No,
Secondly,
that is generally at a process level.
okay,
In my mind, if a VC or an investor tells you pay me money before I send you the investment, it's a huge red flag, and
okay,
you should never agree for more than 5 to 10% transaction cost, even if there is a investor
5
who
to ten
says I
percent
will
is
get you
huge,
other
right?
investors.
5 to 10% is a lot, right?
That's what I'm saying. So never agree to more. But what happens is, in absolute numbers, it's not a
Mm-hmm.
big deal, right? Because suppose you spend 25,000. Abhi yaar, you know it. US mein, if you go to get work done, you'll spend up $10,000 just to sort of ask his name. So,
Right.
so what happens is, you end up spending $25,000 and you're raising 250K. So
Mhm.
you've cost 10% in transaction cost, yeah.
Right. Got it. Okay.
So
Got it.
it's a material number, no? Then
Right. Right. And this term sheet thing, is this something that we generate or the VC sends or the investor sends?
no. So we have to have our terms ready. So what happens is, anybody who's interested in investing in us, because it
Okay.
is quote unquote, look at it this way, right? We are the sellers. We are selling equity in our company.
Okay.
Therefore, it is our price and terms to quote. They
Okay.
may or may not agree, is the next step of the discussion, but it is ours to quote to the table or bring to the table.
Okay.
A VC term sheet is typically like, you can say, where they want to lead, or they want to block you, or they
Okay.
want to keep allocation. So
Okay.
they'll come in and say, hey, here goes this term sheet. We want to allocate this much of the round to us. That is seen as a way to block capacity or block allocation while you're still fundraising, because they don't want you to not consider them.
Okay.
But you can always it's a document definition document, and you both are agreeing on this term, the VC and you.
Okay.
But that doesn't mean cash in the bank. But you can always reject or not choose to go ahead with a term sheet, or even if you have term sheet, I've seen founders who have just, it's not a definitive document on both
So
sides.
term sheet is basically a non-binding. Typically, term sheet is non-binding.
Great. Great. Great.
You may or may
Thank-
not choose to execute.
Okay. Got it. Got it. Thanks, Pranav. Thanks, Sanket.
Hi, Arul. Yeah, go for it.
Yeah, Pranav. So one of the questions I had is, who qualifies as a lead investor? Is it only the percentage of that round, or is it like a established person? For example, if Russian mafia wants to put money in my business, do they qualify as a lead investor, or how do I qualify it?
No, so
It depends on who is the yeah.
So it's exactly like saying, what's the hero of a movie, right?
Yeah.
A hero of a movie is not always a single man who's serenading the actress and defeating the villain, right? That's not always the hero of the movie. The hero of the movie could be 5 in number, or it could be 4 in number. So the same thing applies to a round and a lead. A lead for a round is typically somebody who says, hey, I understand this sector, I understand this space, I have done the diligence on this startup, and I'm saying, come invest in this startup with me. So in fact, a good angel can also be a lead. So to give you a very, very fintech example, I don't want to give Web3 examples, but to give you a very, very fintech example, an Ashneer Grover or a Kunal Shah could tomorrow say, I'm putting in 50 lakhs or 25 lakhs, which is, say, in US dollars, $25,000, right? In a 250K or a 500K round, I'm putting only 5% or 10%, but I am leading this round. I believe this is the startup, this is the wave of the future, and come invest in it with me. So that could be the lead. If the Russian mafia is coming and investing in you, and your business is selling vodka in Russia, then definitely I'm going to consider them as a lead.
So basically, in that space, they have to be well-known sorts.
It's not, see, the point is, a lead investor, if somebody like a micro VC or a syndicate tells you find a lead investor, I generally tell the startup that he's saying a polite no, because you had a strong intro. He's politely telling you a no, and he's saying he's keeping his door open, because if suppose tomorrow Sequoia says yes to you, then he can always jump in and say, I'm also here. But that's a polite way of saying no.
A lot of Indian So there's a problem of saying no with many of us, in the Indian ecosystem, right? We would rather choose to stay silent than saying no. But the Western Hemisphere is very different. They will tell you upfront with one follow-up to say that, hey, this does not match our thesis, or we are not too confident on this sector, or whatever, and they'll come back to you with a no.
And your lead investor is will always set the terms. The rest of the investor will fall in line or in principle agree with them.
Got it. Understood. Sure.
So one thing I haven't mentioned on the presentation, I didn't want to put it in writing, was actually that there is a underbelly here, which is side letter, which a lead investor may want you to ask. And because we're talking lead investors, it's important to understand this concept. Sometimes an investor or a micro VC or a VC may come around and say, I will lead this round for you, but I want something special because, quote unquote, I'm leading it for you, right? So they may ask for special rights, they may ask for priority. It is generally not fair to ask for a commercial advantage. What is acceptable in the market is a governance advantage. So your lead investor may get a board seat, or maybe the board observer nominee. They may get the option to nominate a board observer, or they may get certain other oversight rights which everybody does not have. But typically they will not, or they may get a small, I've also seen they get an advisor post for somebody who's in their company and stuff like that. So not paid, I'm saying unpaid. But the idea is that they want to be more involved in the business because they're taking the lead and they're sort of responsible for the investment, and they are a large part of the round. But that will only happen when you're looking at a typical 25 to 30% of the round being written by that company or that group.
Got it. Sure. Okay.
So I wanted to understand how much of a role can a celebrity investor play if they are even investing very small amount. For example, if you can get a big creator and even if they are investing a few lakhs, will using the name play a huge role in convincing others?
Always, right? Always. Because it doesn't really matter what the terms between the quote-unquote celebrity or the influencer and you are. If the fact that they can influence the investor ecosystem, then that's it, right? That's a win. And 100% everybody gets influenced.
It's signaling, right?
Yeah, it's signaling. The idea is successful people, the notion in the world is that successful people know how to identify other successful things. So therefore, if one successful person identifies and agrees and openly commits to you, then that makes you that much more higher likelier, more probable to succeed.
I see.
Make sense?
Yeah, makes sense.
Yeah, one other thing as part of the business part of it, ensure that your bank accounts are able to accept both small amounts, large amounts, whether your vehicle is going to be direct bank transfer, is it going to be through, some people will come through if you're opening up through angel list or through a syndicate, the way you're going to receive the money also needs to be understood so that you know which channel to follow up and for whom, right? One aspect of it is having too many people on your cap table is a challenge, especially for people coming on low ticket sizes. So when those conversations come, do not hesitate in asking what's your typical ticket size, how much are you likely to invest, so that you are better prepared on how you want to take that money, right? So typically, why is this an issue when you have too many people on your cap table? In India, you can have up to 225 people on your cap table, which is the upper limit. Now imagine if you have 200 people all putting in 5 lakhs. Tomorrow when you go for another follow-on round, you want to get or you want to update the cap table with additional activities, you need to literally get signatures almost from everyone, right? So this cap table management is a big challenge, and hence when you're doing a friends and family round, or when you're trying to do a round of even 500K, and when you have a lot of investors coming in smaller ticket sizes like 2 lakhs, 5 lakhs, etc., it's better to club all of them into a single entity like AngelList or through Let's Venture, or you make all of them If they know each other well, you can help them to create an LLP and they invest via that LLP, come in as one single entry onto your cap table. That's how you can look to minimize the number of signatories that you would require on your cap table.
At what stage do we need to engage a lawyer or someone to confirm or validate what we are doing in terms of acceptance terms of term sheets, etc.?
That will be mutually done once you have accepted in principle or in oral. Then in the due diligence part and post term sheet part, people will get involved on both sides.
Are you saying that needs to be done at pre-seed or seed or Series A?
Every round, the moment you are taking money, you need some paperwork to be done, and usually even the investors have their own lawyers and everything to just recheck the docs, have some due diligence inside the company, check if everything is in order or not. So that will happen pretty much every time until I think it's a very, very small friends and family around where you have trust.
So,
Yeah, I would say the moment
there is an associated question I have that legal costs sometimes they can keep adding up, and so I have come across lawyers who work for a small portion of equity, but then like once you give them that equity, they will do everything. Is that
That's why
something that
investment
we should
advisory
think about?
firms usually, some people I've seen employ that. They take typically 0.25 to 1%. They'll do your whole round structuring. They'll connect you. It's mostly a banking cum legal service.
Yeah, but is it advisable? Are
Depends.
their
I think
interests aligned?
Pranav sir can give a better idea.
if you're pushed to the wall, you will do that. If you're not pushed to the wall, get it done over cash and get done with it.
Okay.
Sorry, Nikhil, I missed the question. Means, are you saying equity is good or bad, or are you saying
No.
giving
Giving equity to lawyers to do the legal work.
Equity
See, the
again.
only problem with a lawyer, and I have dealt with, just for context, I've dealt with more than 50 law firms in over a dozen countries. So I'm truly speaking from experience. Lawyers are often doing a shitty job. So what happens is, you get somebody on your cap table, no? That person will keep fingering your entire life legal work because it's a lawyer ultimately. You can't win against a lawyer. So it is better to not get into get a lawyer on your cap table for this reason. A lawyer by profession, but an investor in your cap table is a different story, but not equity for work.
Got it. Yeah, that was exactly what my question was about. Yeah.
So my
So
suggestion is the moment you decide to kickstart your fundraising, even if you're copy pasting YC's safe note, for example, you have to employ a lawyer to be on your side for two reasons. One, to draft your term sheet to the terms that you want. Second, when you get a term sheet from the investor, that they review and tell you what to look out for from your interest point of view.
Exactly. And see, that's why the slide, right? The slide was exactly for this intent. A good investor will mark up your term sheet / safe document with something or the other. If there is absolutely no markup from any of the investors, then that's a great result. You can always tell the lawyer, hey, we had nothing much for you, let's wrap this up. But if you do get that, then it saves you precious days in the middle of a fundraising to find a lawyer, do those calls with the lawyer, get their retainer, get their services agreement signed up and all of that, which can often take up to 2-3 weeks. My suggestion is, if you are fundraising, and I know our launch camp startups are at a particular stage, so we are all early stage, none of us are sort of highly evolved Series A companies. So I'm saying, please don't go to the Sequoias and the A16Zs and the Blooms of the world unless you're like Santosh and they've already funded your previous startup and you know them really well. If that's the case, go for it. But otherwise, please start off with your friends and family, your advisors, your close professionals. If you're a working professional who's had a corporate career, talk to your bosses, people who you know are investing. If you've gone to any B school, tech school, talk to your batchmates. Surely some of them are investing. The advantage here is you will very quickly, in 5 or 7 rounds, it's like going and doing net practice, or like we say mock trading. before putting real money on the stock market. So you get a lot of net practice through that exercise, and you also end up potentially getting some commitments which make you more confident to pitch to others. And if your round goes great, you can definitely take it from me that I would always 100 out of 100 times tell you, keep some allocation from friends and family, because why would you not want them to make 10x on their money if you're making it for people who you don't know. Secondly, there is a very important concept you should understand. Now, I ask all of you to wear a investor's hat, okay? Come on this side of the line where investors are sitting and not as founders. Now, think about a young 25, 30-year-old founder who's standing in front of you with 5 years experience, no product, no customer, no revenue, just an idea and a presentation. They have no way to believe in what you will be able to deliver or not. So why should they invest in you? So a great way to build the confidence is, if you go and say, I have friends and family allocation and commitment of $50,000, they know that people who know you for the whole life are saying that you can do this, therefore they are okay to back you. And alternately, if you're somebody my age, if you're 40 years old and you are starting up now and you can't raise the first $50,000 from your friends and family, then it makes it look like, hey, if his friends and family don't back him, then probably Pranav's not the right startup idea. So you can always not draw down from your friends and family if you don't want to. But my suggestion always is, if you're raising capital in the market, please keep an allocation for your friends and family. Let them also participate in this with all due risks and rewards explained properly. Explain the whole risk process, the risk in the whole process, but please give them an allocation.
Explaining Web3 to friends and family is a challenge. I mean, they might put in money because they trust you and they're part of the family. But is it right to take money when they don't really understand the principles behind Web3? I kind of conflicted over there.
So there is no harm, right? They are betting on you. They are not betting on Web3.
I see.
They are betting on, I am betting on my brother, I'm betting on my friend, I'm betting on my neighbor. Because I don't understand Web3, but I know this guy is a smart guy, he'll make something out of it. I'm betting on that person. Secondly, there is no right or wrong, right? As long as they understand the risks of equity investing, angel investing, it should be okay. Because if it was a old school corner store, they wouldn't be able to make this upside, but they wouldn't have the same risk. So that is what is to be explained to them. Whether they understand Web3 or not is a different thing. Secondly, everybody here is a Web3 founder. If you are shying away from explaining Web3 to people around you, then you don't deserve to be a Web3 founder. Please do not do that.
Yeah, that's also true.
So please, as Web3 founders, all of us are having the responsibility of taking Web3 to our immediate friends and family. And you should never say never for a conversation of explaining Web3 to those guys. Where and how can we help? So what we're doing is we're basically coming out with monthly flip books. This is a listing of all our companies that we are recommending and we are raising for in that month. Don't go strictly by month as in calendar month. What I mean to say is at that point of time. So the idea is that whoever is ready, we will take to the market. So suppose I'm doing a flip book next week, 15 Jan, then whoever's ready 15 Jan, fully ready, we will take you to the market. Suppose you're ready 15th Feb, we'll take you in the Feb book. If you're ready 15th April, we'll take you in the April book. It doesn't matter. But the idea is that we will do monthly flip books so that we can take all our startups that are raising money to our entire investor network. Because we don't want to second guess ki, hey, will Pranav invest in a ticketing company, or will Pranav invest in a content company, or will he invest in a tooling company? I don't know. So we are not going to go and say he won't or will not. The idea is we want to be able to reach out and give maximum visibility to our startups who are actively fundraising. You never know what lead leads to what outcome. Therefore, we want to showcase whatever is the not whatever, whichever are the ongoing fundraisers in our ecosystem, and we will keep updating that as we go. So once we evaluate and we figure out that yes, you're ready to raise, we will put you in the next flipbook update where you will get inbound interest from people in our network. So what will happen is once we complete the investor outreach, I may ask you to do multiple pitches, because sometimes there is some investors we can put in one room together, especially folks like our coaches, etc. They're well known to us, they're well known to each other, we can put in one room. But sometimes it's also VCs who we can't put in one room, so we may not, so we may ask you to pitch one day on Tuesday and once on Thursday, right? So please seek your cooperation on that part. Last fourth point is that when I say ready, what do we mean when I say ready? It means that we have our data room ready, we have our demo ready, whatever is the right information package for that company, everything from pitch book to data room and demo should be ready. And therefore we will take you, because once we send out a mail and outreach to 50-100 people, we will start getting at least some inbounds immediately. So then we can't start saying that my pitch is not ready, I'm still figuring out what to do, my data room is not ready, my term sheet is coming on Monday, and stuff like that. I'm again requesting, please do not go to large VCs first. If you go to large VCs on your own, we are unable to help you later on with those VCs. So, and trust me, unless you know the VC very, very well, that large VC is not going to write a check in a first round, first fundraise of a company of our size. So it doesn't really help us, it only hurts us. We can go to micro VCs, absolutely go to syndicates, 100% reach out to all angels in your extended network. Do all of that, but do not go to the large VCs first. If you have super angel network and super marquee angels, only then can we make a very, and we will find the right VC, and we will try and find the right intro into that VC, so that we are able to open the door and get a warm introduction to be able to pitch to that VC. And anytime if you feel that, hey, this company or this syndicate is a great fit for our business and we would love to approach them, please feel free to ask me or anybody in our team for specific connects. So it could be any VC, it could be a syndicate, it could be an angel. You never know who's connected to whom, but we can always try and help you reach that connection or make a connection to that person. So that was the sort of one overlay I wanted to share with everybody. And what I will do is I will also share our pitch book with everybody on Launchcamp 1 and 2 once it is out. Hopefully by next week is when we start our pitch books. So that's how we're going to run the capital system for now. And lastly, I have this section over here on how do we reach out. This is what I was just saying: advisors, friends of the company, known contacts who can be revisited. This allows you to form up your pitching and clean up your deck and documentation. And it also, if you get some converts, it makes you much more confident and gives you much more conviction. Second outreach is your main round, where you're going to like 40-50 companies, VCs, syndicates, angels, everything. And this is where you get the bulk of your funding done. And the last is what I will say, it says repeat outreach over here, but the idea of over here is like it's a sweep up round, where after you've got to 60-70 and your minimum threshold is met, you basically go back to early guys, or you go back to guys who you couldn't reach out to, or you go to ask for leads from your confirmed investors and basically figure out how to get that going. And that's sort of how I would structure a typical outreach. First is very close friends and family advisors. Second is large network, the bulk of the actual fundraising. And lastly is the sweep up round or the repeat outreach round. So that's it from me for today. Happy to answer any questions which are there on the foundership role on this fundraise. I think this is our year here. I'm super bullish. I don't know. My gut says the market turns between March, April, and June. So that's just my gut feeling. We can't afford another recession. Politicians like their jobs too much. They like their
Right.
power too much. So
Right.
I believe before June, Fed would have pivoted and at least stopped any rate hikes, and potentially even look at giving a contraction plan for the next 4 quarters. So I feel there is definitely some turnaround. Plus, just from a timing standpoint, next year, April, May is the next halving for Bitcoin. And historically, that's been an important milestone where the market has turned for crypto.
Mhm.
It also tallies with the overall macroeconomic timeline, which is about 18 months from now or 14 months from now. So it may be that we have one more slow year. And my take is, if we need, if we are building like all of us are,
Mhm.
the most important thing is to take the money when you need it the most, and we can always figure out how to extract more value if we deliver on our promise, right?
Right.
So that's not a problem. We can always, there are multiple options and I'll only give you those options, don't worry. So we can always course correct and improve our valuation later if we get successful. But today, if there is venture money available, that is risk, that is taking the risk on betting on you, then my suggestion is to take the money and build, and use this bear market to basically optimize your cost, because you get better talent now, you get better prices for marketing, you get better prices for any form of subscriptions, you get better prices for office space. So generally in a bad market is a great time to get more bang for your buck. So what would have been a 500,000 budget could actually be achieved in 400K in a bad
Okay.
year.
Okay. That makes sense.
So that's sort of how I look at it from a very, very old school business perspective, which will still apply whether it's Web3 or not.
Good.
Perfect, guys. So it's slightly over an hour, but happy to answer any more questions. The thought here is to have you guys share your thoughts openly, transparently. We are always there for you, and learn from each other so that we don't make the same mistakes twice. Cool.
Checks ready, guys. Get those checks ready.
We'll get you. Yeah, means I don't. I'm telling you, for the right, and guys, means always have a 2 minute pitch here. I always say that any investor call is going to be a 2-3 minute hook, right? In 3 minutes, you either got the person. It's exactly like you're hitting up somebody at a bar. In 30 seconds, you know whether it worked or not.
Okay. We'll
After
practice
that, it
there.
doesn't
We'll
matter.
practice there.
100%. So if it doesn't work in the first 30 seconds, it's a waste of time. Let's move on. So it's
Okay.
exactly like that with investors also. In the first 5 minutes, you'll know whether it's working or not. Otherwise, you can move on.
Good. Good.
And see you all on Block Meet 21st of this month in 30 plus cities. So anywhere
Yes,
you're in, you can
guys.
just hop in.
Sure. Sure.
We absolutely want you to lead the community outreach in your respective home cities. Okay.
Okay. Thank
Thanks.
you all.
Thanks a lot,
Thank you,
guys.
Pranav. Sanket. Thank you.
Bye.
Thank you, everybody. See you all later. Bye.
Bye.
Bye, everybody.